Okay, let's unpack this. So, I want you to imagine you're standing on the floor of the New York Stock Exchange. People are shouting, screens are flashing, numbers are just flying by, and everyone is trying to predict the future price of a commodity. But instead of buying shares in, like Apple or Tesla, the commodity being traded is a horse.
That is exactly the mental shift you need to make for this deep dive.
Hmm.
And honestly, if you can make that shift, you unlock a completely different way of looking at sports.
Today, we are diving into a really fascinating stack of, research and trading notes, all focused on these 10-minute trading strategies for the Betfair market. And the first thing that jumped out at me, and I mean really jumped out, is that this isn't about gambling, not in the way most people think about it. We aren't trying to pick the horse that runs the fastest, are we?
No, absolutely not. And that is the hardest hurdle for people to clear. If you're looking at the form guide or, checking the jockey's win rate or looking at the soil conditions to pick a winner, you're punting, you're gambling. What we're talking about here is trading. It's a high-speed strategic market. It behaves much more like a stock exchange or a currency pair than a racetrack.
It's basically day trading, but the market opens and closes every 20 minutes or so.
Exactly. And the guide we're analyzing today is very, very specific about this. It doesn't tell you how to trade all day. It's a masterclass in capitalizing on a specific window of time, the 10-minute window.
Which seems so short. I mean, we aren't talking about studying the race the night before, and we're definitely not talking about that chaotic split-second finish where everyone is screaming at the TV. We are laser-focused on just 10 minutes before the off.
And there's a very specific reason for that. It's not magic. It's all market mechanics. The source material calls this a transition phase. It's this critical moment where the market shifts gears from being sort of a speculative, quiet marketplace to a high-volume financial engine.
Okay, let's dive into that. This first segment is what I'm calling the Goldilocks zone. Because the reading, it talks about this balance, between things being too quiet and things being way too loud. So why is the 10-minute mark the sweet spot?
To understand that, you have to get the difference between volume and liquidity. And I know for a lot of people, those words probably sound like synonyms.
I have to admit, when I first read this, I thought they were basically the same thing. Doesn't volume just mean there's a lot of money in the market?
In a general sense, yeah. But for a trader, the distinction is, well, it's life or death. The source defines volume simply as the total amount matched. It's a cumulative number. It's historical. It tells you what has happened. But liquidity is the now. It's the rate at which money is being matched per second.
Okay, let me try an analogy. So volume is how full the swimming pool is. But liquidity is how fast the water is flowing out of the hose to refill it.
That's a great way to put it. Or think of it like traffic. Volume is saying 10,000 cars drove on this road today. That sounds busy. But if you drive on it right now and there are 0 cars, there's no liquidity. There's no one to interact with.
And why does that matter specifically at 10 minutes out?
Because as a trader, your safety net is your ability to exit. You need to be able to enter a position, sure, but more importantly, you need to be able to reverse that position instantly if the market moves against you.
Right, because we aren't holding the ticket until the end of the race. We're
Yeah.
just buying and selling to, scalp a tiny profit.
Correct. If you only look at total volume, you might see a big number. Maybe someone dropped a huge bet an hour ago and you think, great, active market. But if the liquidity of the current flow is slow, you enter a trap. You put your money down, the price ticks against you, and you try to sell to get out. But there's no one there to buy. You're stuck.
That's that slippage the text talks about, isn't it? Where you have to take a terrible price just to escape.
Exactly. And if you can't get out, you're no longer a trader. You've just accidentally become a punter holding a ticket you never wanted.
Which is the nightmare scenario. So the 10-minute mark is where the flow starts.
It is. The source describes the flow of money very clearly. At 10 minutes, the smart money begins to arrive. The on-course bookmakers start hedging. The liquidity picks up noticeably. It gives you enough action to get your orders filled without the chaos that comes later.
And looking at the timeline in the text, it seems like things ramp up pretty aggressively after that. It's not a slow burn at all.
No, it's exponential.
Yeah.
There's another surge around the 5-minute mark. And then, to quote the source directly, at the 2-minute mark, the market goes completely mental.
Completely mental. I love that very technical terminology.
It's accurate, though. That 2-minute warning is what they call the scrum. It's just high volatility, erratic price swings, bots firing milliseconds apart. You don't want to be trying to initiate complex strategies in there. The 10-minute window is the safe harbor. It's where you have enough action to trade, but enough stability to actually think.
Okay, so we are 10 minutes out. We have our coffee. The market is waking up. We're looking for liquidity. Now, this is where it gets really interesting, Benny. We need to figure out which way the price is going to move. And the source introduces this concept called weight of money, or WOM.
This is the technical core of the whole strategy. But you take one thing away from this deep dive, it should be understanding weight of money.
And I have to say, reading about the Betfair API data felt a bit like decoding the matrix. It's completely backwards. It kind of broke my brain for a minute.
It is very counterintuitive, yes.
Yeah.
It flips the logic of a standard bet on its head.
Walk us through this. The source talks about bet type 1 and bet type 2. So if I see a huge spike in bet type 1 volume, my brain says, okay, type 1 back volume. That must be people backing the horse to win.
And that is exactly where you would lose your money. That's the trap.
Right. So break it down. What is bet type 1 actually telling us in the order book?
Okay, so just visualize the trading ladder. You've got two sides, blue and pink usually, back and lay. Bet type 1 refers to the back volume available on the screen, but, and this is the key, it represents money available for you to back.
Okay, so if it's available for me to back, that means someone else has put it there offering to lay it.
Bingo. Think of it as the supply side. It's the money sitting there saying, I am willing to bet against this horse. For that money to be matched, you, the backer, have to come and take it. So if you see a massive wall of bet type 1, it actually represents resistance. It's a wall of people betting against the horse.
Okay, that makes sense. It's the lay side showing its hand. So what about bet type 2?
Well, bet type 2 is labeled lay volume. But again, you have to ask, who put it there? It represents money available for you to lay.
Meaning someone else has put their money down saying, I want to bet on this horse, and they're waiting for me to take the bet.
Precisely. It is a queue of backers.
So if I see a massive wall of lay volume, that actually means there's a ton of money just sitting there waiting to bet on the horse.
Yes. It represents pure demand.
This is the aha moment. So if I'm looking at the screen and I see this huge column of bet type 2 volume just building up, what is the market actually telling me?
It is screaming that traders want to back this horse. It is backing pressure.
Even though the API literally calls it lay volume.
Yes. Ignore the label, look at the intent.
Yeah.
That volume is money sitting there offering odds, just begging to be taken. If there's a ton of it and it's piling up, it shows where the real interest is. The source puts it very simply. If you see massive bet type 2 volume, it is not laying pressure. It is backing pressure.
And when you have that much backing pressure, when demand just outstrips supply, what happens to the price?
The odds shorten. They steam in. The people offering the odds see all that money waiting to back the horse, and they think, well, I'm not giving them 4.5 anymore. I'll only give them 4.4, and then 4.3. And the price just drops.
So the strategy here isn't just guessing. It's about looking for a specific imbalance in that queue.
That's it. The source suggests looking for a volume imbalance, specifically a ratio greater than 2 to 1.
So twice as much money on the demand side as the supply side.
Right. If you have that 2 to 1 ratio, specifically with that bet type 2 pressure we just talked about, and the current price is deviating from historical averages, that is your signal. That is the green light the dam is about to break.
Okay, so we've spotted the signal. The matrix is decoded. We see the imbalance. Now we have to actually, push the button. The source outlines two main ways to play this, steamers and faders. Let's start with the steamer.
A steamer is just the industry term for a horse that is being heavily backed. Its odds are dropping rapidly. It's steaming in.
So everyone wants a piece of this horse.
Exactly. And the strategy is pretty straightforward, but it does require some nerve. You back it immediately.
You jump on the train.
You back it at the current high price with the specific intention of laying it off. So, betting against it at a lower price a few seconds or minutes later.
And the difference between those two prices
is your profit. By doing that, you create what the source calls a free bet or a green book.
I love that concept. Can you explain Green Book for anyone who hasn't used the software?
Sure. On the trading software, profit is usually shown in green. If you back at 4.0 and lay at 3.5, you've made a profit. And you can use the software to spread that profit across every single horse in the race. So no matter which horse wins, even if your horse falls over at the start, you make money.
That is the holy grail right there. A guaranteed profit regardless of the result.
It is, but you have to catch the move early.
The source mentions something interesting here about psychology when it comes to steamers. It says the movement is self-fulfilling.
Oh, it is. Momentum is a powerful drug in financial markets. When other traders see the price shortening, when they see it steaming, they get FOMO. Fear of missing out. They jump on because they don't want to miss the move. That new money pushes the price down even further. So by getting in early at the 10-minute mark, when you first spot that whim imbalance, you're effectively riding the wave of other people's psychology.
You're surfing on their panic to get in.
In a manner of speaking, yeah. You're front-running the herd.
But the herd doesn't run forever. Eventually, the price has to hit a wall. And that's the second strategy, right? Fading the move.
Right. Markets don't go in a straight line forever. Eventually, the price hits a floor where the value just isn't there anymore.
The source talks about the price flatlining. What does that actually look like on the screen?
Well, you'll see the price chart flatten out, obviously. But the key indicator, again, is volume. The source says to look for volume accumulating at the bottom of the ladder.
So just heaps of money sitting there trying to back it, but the price isn't moving down anymore.
Exactly. It's hitting resistance.
Yeah.
The market is basically refusing to back the horse at that lower price. It's too expensive now. The rubber band has stretched as far as it can go.
And that's when it snaps back.
That's the drift. So in this scenario, you do the opposite. You enter a lay bet. You bet against the horse at the bottom,
Expecting the price to go up.
expecting the price to bounce back out. Then, once it drifts out to a higher price, you back it again to close your position. You're selling high and buying low, just in a very, very short time frame.
It really is just like day trading. You're looking for support and resistance levels.
Ideally, yes. You're identifying that the market has overreacted to the steam, and you're profiting from the correction.
Okay, so we've made our trade. Maybe we rode a steamer down, or maybe we've faded a move and caught the bounce. We're feeling good. But the clock is ticking. We started at 10 minutes. Where are we now?
This brings us to the most critical rule in the entire document. If you ignore everything else, remember this. The exit strategy.
The 2-minute rule.
Discipline is paramount here. The source is unequivocal on this. If you open a trade at the 10-minute mark, you must be closed out before the 2-minute mark.
Why is that line in the sand so rigid? Why not stay in until, say, 1 minute if the trend is good?
Remember the scrum we talked about? At 2 minutes, the market characteristics just change suddenly. It becomes chaotic. The liquidity might be there, but the volatility is off the charts. Predicting price direction becomes nearly impossible because big money, smart money, panic money, and the algorithmic bots, they're all hitting the market at once.
But there's a technical reason too, right? Something about the pictures.
Yes, the broadcast delay. What you see on your TD or your stream is delayed by a few seconds. But the people at the track, the in-play traders, they see reality in real time.
So they are ahead of you.
If you're trading at 159 and the horse gets agitated in the stalls or throws a shoe, the price will move violently before you even see the horse act up on your screen. You're flying blind.
So if you are still holding a position at 1.59,
You are in the danger zone. The risk is that you physically won't be able to match your exit trade before the race goes in play.
and in-play trading is a completely different beast.
Entirely. The source warns that in-play trading carries these outsized risks. A bad start, the horse stumbles, or misses the break, that can wipe out your entire capital in a second. If you have an open position when the horses jump, you are no longer trading. You are gambling. And you're gambling with zero edge.
The golden rule: we are trading, not gambling.
Exactly. The trader never, ever wants an open position when the race starts. You want a flat book.
But let's play devil's advocate here. What if you get stuck? You're trying to get out, the clock is ticking down, 2 minutes, 1 minute, and nobody is matching your bet. The market is moving away from you.
This is where the source provides a get-out-of-jail-free card. It's a function on the exchange called Take SP.
SP stands for starting price, right?
Yes, the official starting price determined by the industry.
So how does it save you?
If you cannot manually match your exit trade, maybe the market is moving too fast against you, you can select Take SP on your unmatched bet.
And what does that do?
It basically instructs the system to convert your unmatched position into a bet at the official starting price the moment the race begins.
So it forces the match.
It guarantees a match. It ensures you are flat or hedged when the race begins. Now listen, you might not get the profit you hope for. You might even take a small loss on the trade. But what it does is protect you from the catastrophic loss of having a naked position open during the race.
It's like an emergency eject button on a fighter jet.
It is. You lose the jet, but you save the pilot. And the source really emphasizes using it. If you can't get out manually, hit the button. Do not let the race start with you exposed.
It's amazing how much of this just comes down to discipline. We started with this idea of the 10-minute window being a strategy, but really it's a framework for discipline.
That's the perfect summary. It provides structure to the chaos. It tells you when to start, what to look for, and exactly when to stop.
So let's just recap the journey here for everyone listening. We start at 10 minutes out. Why? Because we need liquidity, not just volume. We want to be able to enter and exit smoothly before the madness starts.
Correct. We're in that transition phase.
Then we look at the data, we decode the weight of money, and we remember that inverse logic. Bet type 2, the lay volume, is actually the backing pressure. We're looking for that 2-to-1 imbalance in the queue.
We are listening to what the market is screaming at us. We're looking for the crowd's intent.
Once we hear that scream, we execute. If it's steaming, we back it and ride the FOMO wave down. If it's flatlining at the bottom, we lay it and play the bounce.
Always looking for the reversal to lock in that profit. Green up the book.
And finally, the hard stop, the 2-minute rule. We get out before the scrum, and if we can't, we smash that Take SP button to save our skins.
We treat it as a financial market, strictly. No rooting for the horse, just watching the numbers.
It's fascinating as it takes the sport completely out of it. You could be trading widgets or currencies for all it matters.
It really highlights that crowd wisdom, that weight of money. Isn't just dry data. It is a visualization of human psychology.
How so?
Well, think about it. When you see that steamer, you aren't seeing a horse getting faster. You are seeing fear. Fear of missing out. You are seeing greed. When you see the fade, you are seeing rejection. You are seeing a crowd collectively deciding, no, that's too expensive.
It's fear and greed playing out in real time on a ladder interface.
Exactly. And the provocative thought I'd leave you with is this. In this specific 10-minute window, understanding that human psychology, the panic, the momentum, the herd mentality, is significantly more profitable than knowing anything about the horse itself. You don't need to know if the horse likes soft ground or hard ground. You just need to know what the human beings trading that horse are feeling.
The horse runs the race, but the people run the market.
Precisely. And if you can keep your head while everyone else is losing theirs, that's where the edge lies.
And that is a wrap on the 10-minute window. Thanks for joining us on this deep dive into the mechanics of Betfair trading. It's been an absolute education.
A pleasure to analyze it.
We'll see you on the next one. Keep your positions flat and your discipline high.